This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John, and welcome back.
Morning, Gord. Good to talk to you again.
It is, and we always say every month, it goes by quickly, and every month, what we're going to talk about is different than we thought the previous month. John, I want to jump right in because there is a lot of things that I'd like to cover here today. Because you've been pretty prolific as usual with your writings, and I want to touch on them. But John, I have a chart here of a roadmap that I've been kicking around at Gordon T. Long on a number of fronts, and it's speculating on what I think will unfold. That is quantitative easing for what's referred to as helicopter money or overt monetary funding, the possibilities of negative interest rates, nominal rates, what that'll mean, and even collateral guarantees as a potential crisis or the economy slows. And I'd like you to get your articles are suggesting to me, and I'm showing a chart here now, that the credit cycle leads markets. And we have three cycles: the credit cycle, the business cycle, and the rate cycle, at least how we look at it here. And the credit cycle always tells you what you can expect that's going to happen with the business cycle. And I think it's very well advanced. And even though the markets aren't truly reflecting it, the equity markets, they're on the tail on the end of the dog. They're always, and when they happen, it happens like a dog wagging its tail. It's abrupt and quick. And I looked at your articles that I have up here now. And I think that the essence of this, and tell me if I'm right or wrong, is that you're arguing that the credit cycle really has changed and has reversed here.
Yeah, well, that is exactly what I'm saying, and it shouldn't be a surprise because we're 6 or 7 years into a recovery now, that's an extremely long recovery. You normally get a recession after 4 or 5 years of growth, and so it shouldn't be a surprise to anybody that we've got a slowdown going. But this is a whole different animal from slowdowns of the past because it's coming at a time when interest rates are already at extremely low levels. We have monetary policy around the world and fiscal policy in a lot of cases that should be generating massive inflationary booms just because governments are borrowing and spending so much, and interest rates are at zero in a lot of places, negative in some places, which would normally incite a lot of borrowing and a lot of malinvestment, which blows up a bubble, which causes a crash. Well, now we're seeing a slowdown under those circumstances, which kind of implies that there's something different going on this time around. And there are several things that are new to this cycle that are especially ominous. And one is that China was the real engine of growth coming out of the 2008-2009 crisis, and kind of under the radar, they borrowed $15 or $20 trillion and did the mother of all infrastructure build-outs, which sucked commodities from the whole world into China and bid up the prices of everything. Well, their cycle has ended. They borrowed pretty much as they can borrow, build as much as they can build, and now they're not buying as much oil and copper and iron ore and many other things from the rest of the world, and that's causing prices to plunge. So we've got a commodities crash going on during a recovery, which is highly unusual. And that's cutting corporate profits almost across the board. And at the same time, we've got wages starting to go up in the U.S. because the pendulum between corporate profits and worker wages had swung way, way, way too far in the direction of corporate profits. And so companies like McDonald's and Walmart are finding that they have no choice but to raise wages dramatically, but that cuts their earnings dramatically. Walmart just announced a horrendous quarterly earnings report and intimated that this is going to be the new reality for several years out. And so how do you have an equities bull market and a recovery in economic growth in general at a time when the main engine for growth, China, is sputtering, and corporate profits in the US in particular are starting to turn down hard? And the answer is you don't. You can't grow under those circumstances. So it's pretty clear that a slowdown is gathering pace around the world now. China, by some measures, isn't growing at all. Japan is flat on its back because of debt and demographics. Europe is in chaos because of the Eurozone's fatal flaws, which you and I have talked about a lot, added to the Syrian refugee crisis, which is just swamping the European countries. And now the US is seeing a corporate profit slowdown. So there's no real help out there in the world that's visible right now. And that leads to what you said about next generation monetary policy. Things that used to be considered absolutely crazy, that we'd never see in our lifetimes, that no normal economy would ever attempt, are going to be attempted in 2016. The Guardian in the UK, which is a newspaper that was always pretty well known, but gained fame around the world just lately by publishing Edward Snowden's leaks. Just came out with an article that I think was really telling, because it was a really good analysis of how we got here, and which is not unusual, to see in, for instance, the sound money community. There's a lot of analysis that gets at the points that the Guardian makes, but then the Guardian takes that as the platform to call for some radical changes in monetary and fiscal policy. Let me just read you a couple of sentences from it, because I think this is what's going to be the conventional wisdom in a couple of years. And it said, the world needs inventive responses. It needs a bigger, reinvigorated IMF whose constitution should reflect the global balance of economic power and that can rescue the emerging markets. It needs Western governments to launch massive economic stimuli centered on infrastructure spending, and it needs new smart money policies that allow negative interest rates. And this is exactly what's going to sell politically in the coming year. In the U.S. presidential campaign right now, both Bernie Sanders and Hillary Clinton are talking about stuff like this. And should they get elected, that's going to be their policy platform. In the UK, an old-line Marxist just was named to the head of the Labour Party, which is one of the two major parties there, and which will win the next election if the Conservative Party has any kind of a scandal or any kind of trouble heading into the election. They're the ones who will inherit leadership from the Conservatives. So the world in general is going to start coming around to these kinds of policies where we have to have negative interest rates because zero interest rates aren't working. And we have to have deficits of 8 or 10% of GDP because deficits of 4 or 5 or 6% of GDP aren't working. And so this is a really interesting and terrifying new stage of monetary and fiscal policy because we've never been here before. We've never tried to have global negative interest rates. And the implications of that are myriad. It's hard to know what happens when we try something like that, except to say that there are going to be a lot of unintended consequences that we'll have to deal with. And the same thing with massively increasing infrastructure spending and paying for it with borrowed money at a time when we've already doubled and tripled government debt in a lot of major countries in the last 5 years. China borrowed more money than anybody has ever borrowed in that space of time in the years after the 2008-2009 crisis. The U.S. has doubled its national debt at the federal level, and far more than doubled it if you look at honest ways of accounting for debt like unfunded liabilities and derivatives. So where do we go from here in terms of stability if we double down on these policies that would have been considered crazy 20 years ago, but that we tried in the last 5 or 6 years and that didn't work. And that's the big question in 2016 and beyond, because we're clearly going to do it. There's no politically feasible alternative to doubling down, to going big on monetary and fiscal policy in the years ahead, because the only alternative is austerity. And we saw what happened in Europe when a few countries in the Eurozone tried to deal with budget imbalances by cutting government spending. They dropped into depressions almost instantly. Greece is still in depression, and Spain is clawing its way out. But
yeah, and every one of those governments were changed too. The people threw them out. So it doesn't fly, and it's been proven. So that's why a person like Corbyn in the UK can come out with the platform, the Labour, out of nowhere, the Labour platform, saying he wants quantitative easing for the people. That's his terminology, right? QE for the people. That sounds politically correct, doesn't it?
Well, and it's
economic
really
disaster.
Attractive. Well, I mean, it's going to be massive government deficits to finance some kind of a program that puts money in the pockets of regular people, either big tax cuts or huge increases in infrastructure spending or something along those lines, or just debt forgiveness. Maybe they'll go through the mortgage market and say everybody's mortgage is now cut in half. and see, these things sound completely crazy, but they're the next logical step in the process that we've been in since really the 1990s at least, and maybe before that. So yeah, some kind of QE for the people thing is going to be tried almost everywhere. We'll see variations on that theme, and all of it at its base will involve massive increases in the creation of new currency, massive increases in government spending, and some kind of borrowing to pay for it all. So the fact that QE didn't work and massive deficits didn't work in the past 5 or 6 years is not going to deter these guys, because they're going to come to the conclusion that, well, it didn't work because we didn't go big enough. We didn't do it on a scale that was necessary to confront the problems that we have. And the fact that the problems that we have are due to the fact that we borrowed and spent too much in the past and created too much new currency in the past is going to be lost on these guys, because that's not a politically marketable idea. Only we're going to give you stuff is going to sell in the next series of elections. So that's all that we're going to hear. And yeah, like you said, it's a disaster out there somewhere in the...
Yeah, John, what worries me, many things bother me with this roadmap that I think is inevitable, that whether you agree with it or not, it is just going to unfold. And for example, the next round of quantitative easing or helicopter money, I think we'll see things like it'll be to student loans in the United States. That is the massive $1.3 trillion, and the college costs are prohibitive, the impact on the middle class. It'll be very sellable that we're going to give this massive relief to student loans. But what everybody needs to understand is, of that 1.3 trillion, we have nearly 500 or 600 billion of it sitting in forbearance right now. Not in default, not in delinquents, just simply not being paid, put over on the side, that some financial institutions are carrying on their book. They haven't written it off. So when that money comes out, so this is the way it's flowing, I think it'll just flow into things like giving them relief on the 600 billion that's sitting there that they're not collecting on. So how much money of these programs will actually be stimulative? How much of it will really flow through? None of them have worked in the past. And that's the question that I would really put on the table. But do I think they're going to do it? Absolutely.
Yeah.
Unfortunately.
And you're right. A lot of
they have no choice right now. They have literally no other alternative.
Not from a political standpoint, And what you said about loans being a liability of the borrower, but an asset of the lender, is one of the sticking points here. Because if you're going to pay off somebody's mortgage, for instance, by giving them the money, then you got the bank on the other side of this that was going to hold that mortgage and going to reap a profit from that loan over time, no longer being able to do that. So you're wiping out assets at the same time you're wiping out liabilities. And that's a technically tricky process because everybody's going to want a favorable deal, and you can't have a favorable deal on both sides of the coin if you're wiping out loans and assets. So, this is technically tricky. It's not going to be easy to do, but they're definitely going to try it. And I think the only thing you can say with certainty is that it'll cause instability.
Well, the thing I would say with certainty is who's going to win on that transaction. There's going to be how it's sold to us, the spin that's put on it, and why it's politically correct, but it isn't in reality how it's going to work or how it's really going to be transacted. That is a consistent pattern we've seen for 6 years of kicking the can down the road. I don't mean to be cynical, but we're at a major crossroads here if we're not already over the Rubicon. We don't have too many more opportunities to fix or at least redirect policy in a constructive manner. And I don't see anything indicating it's not going to do just more of the same, and as you say, doubling down.
Yeah. Well, historians, when they sort this century out, are going to probably date the point of no return at 1999. In the 1990s, we had a chance to fix the entitlement state in the U.S. and rein in the various excesses of government and big corporations and the major banks in particular. We didn't do any of it. So since that time, we've just been kind of running on autopilot, where the government basically enables the major corporations to suck money out of the 99% and hand it to the 1%. And debt has gone up to unsustainable levels, and corporate leverage in particular has gone up to unsustainable levels. And now it's being paid for with increasing debt at the government level. And so, there's no way out of this. There's no way to get painfully or painlessly from here to a sustainable system that grows organically and not with increasing leverage and et cetera, and that provides good jobs for middle class people and lifts working class people into the middle class. We can't get there without incredible amounts of pain, and nobody in the political leadership is willing to accept that pain because that means they lose their jobs. So all we're going to see is more of the same on a bigger and bigger scale until the amount of debt that we've taken on blows up on us. And that could be next year. It could be this year. There's no way to know.
Well, some of it, John, is blowing up in real time as we're talking. We saw Glencore, to me, which was just a canary in the coal mine of the large commodity trader, caught on the wrong side of the leverage and all of the high yield. And, when I looked in 1999, dot-com bubble exploded. Really, the big fallout was people like Enron in the commodities, oil trading caught on the long end, and poof, and we're gone. But we could see it coming in the credit market. In 2007, 2008, we saw it at Bear Stearns and Lehman Brothers, over leverage, poof. And remember how quickly that happened? On Thursday, on a Thursday afternoon, the president of Lehman Brothers was saying we're fine. Friday afternoon, the next day, they were under. That's how quickly, when electronically people start moving their money. And we're already seeing it with the commodities players, specifically in the high yield, and very much in the high yield ETFs right now, because we've had so many people go into bonds through ETFs. Where's the liquidity if you want to sell? You can clear it on your keystrokes on your computer and be out of your ETF, but what about the people that have to sell the bonds to clear the transaction? There's no liquidity. The banks aren't holding inventory anymore. John, and as you well know, that is a massive, a large amount. And it's when I'm looking at the hedge funds and some of that are closing down shops right now and liquidating, it's like they're trying to leave the theater because they smell smoke before somebody yells fire, and there's only one exit. And that's my sense because of what I'm seeing. Comments on that?
We have Bain and Fortress, two very big hedge fund management companies, just closed major funds of theirs, and they're just going to give the money back to investors, what's left of the money. And in the aggregate, hedge funds are down a bit for the year, which kind of, and they've underperformed for several years. So that kind of calls their existence into question because they charge really high fees compared to any other kind of investment company. And in return for those fees, they have to generate extremely high returns. And if they can't do that, what's their point? And so that's the question that's being asked by a lot of really well-heeled investors out there who have money in hedge funds, but are just paying these big fees out and not getting anything in return. So you're seeing redemptions across the board in hedge funds. And presumably that's going to mean a lot of hedge fund liquidations in the year ahead. So you got energy junk bonds that are going to blow up in the year ahead because there's a little bit of a lag between a plunge in oil prices and the death of the companies that needed higher oil prices. That's going to happen in 2016. And you've got hedge funds that are in pretty much everything, going bust or just liquidating and having to sell off all their assets. And that's going to cause turmoil in the markets. And then you've got the emerging market economies that borrowed a ton of dollars, something like $9 trillion over the previous decade when the dollar was relatively weak. Now the dollar is strong, and that puts basically all $9 trillion of the carry trade loans that have been taken out in the emerging markets underwater. So Brazil is imploding. Argentina and Venezuela are imploding. So Latin America is a mess. Big chunks of Asia are a mess now, led by China, which claims to be growing but probably isn't anymore. And it's not clear how China holds together politically if they can't supply jobs for the millions of people that are coming in off the farms and moving to the cities with the expectation of a middle-class life as it's defined over there, And so there are a lot of things getting ready to blow up if we don't paper it all over with more newly created dollars or in euros and yen and yuan. And so that's what's coming next year. And so probably we will be able to paper over these crises by creating lots of new currency, but then that shifts the crisis from the real market and the leveraged speculating community to the currency markets. Because how do the currency markets and the derivatives based on currencies respond when we're massively increasing the supply of all these currencies? There's no way to know, but instability is the least that we should expect from what's coming.
And that instability, John, in 2008, it was a financial crisis, and it morphed through into an economic crisis in terms of Europe and around the world, and we're seeing it. And this wave that's unfolding and it's accelerating is a political crisis, because a lot of the things that they need to do, whether they're going to be acceptable, how they're going to package them so they are politically acceptable. We have a lot of conflict now that's going on in the world that we're not paying attention to, that we're not accustomed to this. I'm just looking at things like Syria. Reminds me very much of the Cuban Missile Crisis in a different context, and stand down on it. But in closing here, John, can I ask you to speculate? I have up this roadmap we started with these pillars. As a possible sequence, what would you expect the sequence to be of the things that those developed countries will try? And I know you're speculating.
Yeah, no, we're in the process of seeing a slowdown right now in the U.S. now, and it's been going on in Europe and Japan for a while. So that causes turmoil in the leveraged speculating community, which in turn causes political turmoil in which the governments of the world have to figure out what to do to keep their jobs at a time when there's a financial crisis brewing. They will almost certainly cut interest rates to negative levels, institute a war on cash, because you can't have negative interest rates if cash is still freely circulating. So they'll find ways to make cash either extremely unattractive or flat out illegal. They'll massively increase government spending and do something with that money. They'll do various things. Either they'll just give people tax cuts, or they'll forgive loans, or they'll start building roads and bridges and airports and hire people in order to do those jobs. And, something like that will happen. And as you said, this is going to happen in the context of geopolitical instability, because, it's always interesting when theory works out in practice, because there's a general theory, a general consensus that in times of financial trouble, when countries are grossly mismanaged, they start looking abroad for enemies to distract their people from the domestic mismanagement. And so you get the potential for wars increasing along with financial crises. And that's what we're seeing out there right now. The U.S. made a huge mess of the Middle East and then kind of pulled back. And Russia jumped into the vacuum in Syria. And now we've got the prospect of Russian, U.S., Iranian, and Chinese forces all operating in the same theater on different sides and shooting potentially shooting at each other. Right now, we're just shooting at each other's proxies, but we're buzzing each other's jets and generally playing a game of chicken where one stupid mistake could cause an escalation from a proxy war to an actual shooting war between the U.S. and Russia or something like that, which is almost too crazy to contemplate.
And it's always an accident. It was not planned. An individual does something and it cascades. And it may not be in the Middle East. I'm looking at the South China Sea right now, and that is just as serious a situation that's boiling over. So, and when a mistake happens and you've got your back against the wall and start to react, you never know where it's going to lead. It's an extremely dangerous time, economically, as you said, financially and politically, and they're all integrated. And one little push on one of them brings down the pillars in the other. And it could be a policy decision of some of the things we're talking about. There may be a reaction in the currency markets. They're going to go to quantitative easing and helicopter money, and then boom, suddenly the dollar has issues. You don't know. So it's a time to be cautious. John, we have to wrap. Oh, we could go on as we always do. Any final comments you want to make?
Yeah, just to continue for a second, Gord, with the geopolitical thing. As you said, it can be just a mistake by a fighter pilot,
Yep.
or a panicked action by the captain of a battleship or something like that. When we got this bumper cart thing going on in the South China Sea, where we're sending battleships into what China claims is its territorial waters, and it's promising to defend those waters. This is the kind of thing that can easily lead to an incident that terrifies everybody. And we are so fragile right now financially that the financial markets can't handle any kind of a shock. We can't even handle a bear market in equities. A 20% drop in U.S. equities could bring down the entire global financial system, and everybody's aware of that. But let the U.S. and China start launching missiles at each other's aircraft carriers, and then all bets are off financially. See, these things are interconnected, and one screw up in one area can lead to extreme consequences in all the other areas. And that's where we are right now. We're incredibly fragile, and we've got an awful lot of moving parts out there, any one of which could set off a chain reaction. So yeah, this is an interesting time in the mode of the Chinese curse. So 2016 is going to be a fascinating year.
John, how can our listeners learn more about your writings and your work and your site?
I run dollarclaps.com, which covers a lot of the stuff we've talked about here. And my latest book is called The Money Bubble, co-written with Gold Money's James Turk, which also covers a lot of this stuff.
John, I pray to God next month we're not talking about war.
Yeah.
Or the serious escalating potential of it.
Oh, yeah. Because, these financial crises are almost intellectual exercises. They're interesting to watch, and you can play them with stocks and bonds and things like that. So they're in a lot of ways, they're kind of fun, but there's nothing funny about war. And as the father of two draft age sons, this terrifies me. A lot of my planning is based around protecting those guys from being sucked into some crazy thing in the Middle East or Asia where nobody knows what's going on, and our soldiers are basically just target practice for people they don't understand. I hate the idea of this, and it makes me kind of nauseous even to think about it. So hopefully you are right. We won't be talking about war next time or anytime in the future.
Talk to you next month.
Thanks, Gordon.
Thank you, John.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.